Hello, my name is Paul Hopkins and I'm the Director of Acquisitions at CPI Capital. And in this video, I'm going to quickly cover the latest investment opportunity called Apollo Oaks, which is a build-to-rent community located in San Antonio, Texas. And I'm going to quickly scan through a lot of these slides just for sake of time. We do have a full investor webinar recording that is available that provides a lot more details. And I also have a full in-depth underwriting video that is about an hour long that where I dive deep into the underwriting and show how I built it, the assumptions that I used, and the overall returns. So let's dive into it. This is our multifamily portfolio, totaling 737 units. And of course, our disclaimers. Okay, the story behind the deal. Let's talk about this. So back in May of 2024, at the multifamily conference hosted by our partner and CEO, Seth Ferguson, we met Clay Schlinke and his family, the Invest 5S team, at that conference, and got to know them and listening to their business model and plan, and we became very interested and intrigued in working with them. And so we continued to develop a relationship with these guys over the next couple months. August and I actually flew down to Dallas to meet up with them and have dinner with them to discuss, potential projects further. And in November of 2024, we had a deal that we were looking at together that we went under contract on, but actually canceled the contract during our due diligence. And then in January of 2025, we decided to partner up on another deal in San Antonio, which is Apollo Oaks. So the first opportunity was Apollo at Cross Mountain, and the overall topography of the area made it very difficult and increased the infrastructure costs that didn't make it very attractive on the investor return. So we canceled the contract on that deal, and we were quite bummed about it. And our partner Clay said, "Hey, look, I've got this other land opportunity that I'm looking at. I've already engaged the civil engineer, and I was going to do this deal on my own. But since we just canceled the contract on Apollo at Cross Mountain, why don't we do this deal?" And so we looked at the deal, looked at the opportunity, it looked great to us, and so we said, "Yes, let's move forward." And then we called it Apollo Oaks, which is it was 17 miles away from Apollo at Cross Mountain, but it is located, in my opinion, a better location in San Antonio due to being closer to amenities and shopping and employment. And why did this matter? Of course, because it built the trust with the group, and seeing their overall discipline, and they were giving us the overall opportunity to come in on a deal that they were already going to do themselves, which is going to be a very successful project for our team and our investors. So Invest 5S is a family-owned and operated business since 2002. Clay Schlinke has over 30 years of experience building single-family lots. He's developed over 4,000 lots in the region and on track to develop over 1,000 lots or up to 1,000 lots in 2025. They're also vertically integrated as a developer, broker, and property management firm. And these are just some examples of some of the projects that they developed in the past. Anything from 14 fourplexes up to 332 duplexes, all located in San Antonio. The latest project they are just about to wrap up on is called The Row at Dietz Elkhorn, that is located in Northwest San Antonio. A total of 27 duplexes. They closed on it August 15th of 2024. They started framing it later that month. And their first building was completed in October in less than 3 months. And they'll be completed with the entire project in less than 8 months. all the units were pre-sold to investors. And this is their business plan is they develop basically a BTR community. They sell individual lots or duplexes to an end buyer who wants this property for a cash flow asset. And so they have a great reputation of delivering these types of properties and then managing these properties for their investors at the end of the project. And so they have a huge waiting list of investors that are looking for more of this type of property. And the pre-sold function is a great advantage to our development project. So why we love this deal, like I said, the units can be pre-sold during construction and sold at the certificate of occupancy stage. We're located in a very strong market of San Antonio. As far as risk mitigation, I've increased the expected construction costs, the construction costs that Invest 5S has done on repeat for each of their projects. So I've increased the cost just in case of any inflation, and the overall sales price. I have some sale comps that are later on in this presentation, and I've reduced that overall sales price to add some extra conservatism. And we also have attractive debt, construction financing, that is a fixed rate debt, and I've got more details on that in later slides. So what is this project? It is a build-to-rent development of individual lot sales located in Jolotes in Northwest San Antonio. 7 acres, 30 duplex units, or 60 units total. Each unit is 1,400 square feet, being developed in a total of less than 2 years, and expected closing date on the land of March 31st, 2025. The investor summary, 28% IRR, 50% ROI, 1.5 equity multiple, with an average annualized ROI of 27%, $50,000 minimum investment, and it is a 506c offering, or in Canada, it's called a private issuer exemption. As far as the debt financing, we've got construction financing lined up for a total of $9.3 million. It is 100% loan to cost coverage for the soft and hard costs, or 73% of the total loan to cost, including the land acquisition. It is a fixed rate at 10%. That it will be accruing during the construction and then repaid at the time from lot sales. Fees are anywhere between 2 and 2.25 origination fee to the lender, and I've got it in my underwriting at 2 and 2.25, and it is fixed rate for the life of the loan. As far as the capital stack, the debt accounting for 73% loan to cost comes out to $9.3 million, 10% interest. And then the remaining equity of $3.4 million, 10% is going to come from the general partnership contributions. And then as far as the sale proceeds from each home, it'll be utilized in this order where we will repay the construction debt first, along with the interest, sorry. And then pay off the pref and the investor principal. And then from there, we will follow a waterfall structure for the remaining distributions and profit. So as far as the waterfall, it is a 12% preferred rate of return to the limited partners. And once that 12% return has been paid back, then we return all the investor principal capital. And then once we have achieved that, anything up to a 25% IRR to the limited partners, we will split it 50-50 with the limited partner and general partner. And then anything over 25% IRR, it will be split 30% to the limited partners and 70% to the general partner. The projected investor returns, so on a typical $100,000 investment, basically by the year 2, they will receive $50,000 net profit plus the return of capital of $100,000 for a total sum of $150,000, which is that 1.5 equity multiple. So we're already 50% committed. We're actually more than that on this deal. And so we're on track to closing this property on time and raising all the funds necessary. So market overview. So why Texas? So Texas is the number one U.S. exporter in 2024. It's the eighth largest economy in the world. There's over 50 Fortune 500 companies in Texas, and in San Antonio we have USAA and Valerio that are located there. Their company headquarters. Excuse me. Just some more bragging rights about Texas and its accolades. And of course, where is everybody moving to? As far as the migration trends, Texas ranked second in 2024. It was previously number one in 2021 to 2023. It remains the top destination due to affordable living, job opportunities, and quality of life. So now why San Antonio? San Antonio has a population of 2.7 million, and it is the seventh most populous city in the United States, just behind Philadelphia. And it sounds like it's about to just about overtake Philadelphia for position number six. Median household income is 72,000, and a projected projected growth, population growth of 8.7 over the next 6 years. And of course, San Antonio has a list of accolades that we've got shared here. And San Antonio is basically a strategic transportation hub. You've got Interstate 37 coming from Corpus Christi, which is a major hub and harbor for shipping imports and exports. You also have Interstate 10 that runs basically from California all the way to Florida, that runs through San Antonio. And then you have Interstate 35 that runs from Mexico all the way up to Canada. And so there is, it is a major hub and for trade and transportation and logistics. San Antonio is currently working on an expansion project on their airport, investing $1.2 billion to create a new terminal and 17 new gates. And then you also have infrastructure projects like the interstates I-10 and I-35, where they're basically doubling in size. You drive down through the highways of San Antonio right now, and you see lots of construction happening. They're basically doubling the overall volume capacity on the highways. They see the population growth that's happening in this city, and they're planning for that growth. And major attractions within San Antonio, you got Six Flags, and also the San Antonio River Walk, which is a 15-mile river walk in downtown. It's a beautiful walk through downtown. You got the Alamo, and of course SeaWorld, located in San Antonio. As far as entertainment, you've got the San Antonio Stock Show and Rodeo, along with the San Antonio Spurs, the NBA team. And then you've got great shopping like this luxury shopping center, La Cantera, and then Hotel Emma, which is ranked number 19 out of 4,000 hotels in the U.S. and ranked number one hotel in Texas, located in the Pearl District, a beautiful location and quite an amazing hotel. And of course, you can't skip out on the championship golf courses, the TPC San Antonio and La Cantera Golf Club. And then there's also some unique mini golf courses that are there too, like Pop Stroke, which is co-partner with Tiger Woods, featuring two 18-hole courses and quite a fun landscape around it. The population growth within San Antonio just continues to climb, where San Antonio led the nation in domestic migration in 2023. And then the top population gaining cities over the last 4 years has been San Antonio and Fort Worth compared to other populated U.S. cities. And people think San Antonio as a military town, but it's very quite diverse. So out of the almost 1.2 million jobs, you got great jobs of trade and transportation, retail, financial activities, government, leisure and hospitality, and manufacturing. So a very diverse economy. Now, as far as the growth by the top five industries, manufacturing being the top, trade and transportation, business and professional, and education and health. And San Antonio is very, as far as the growth domestic product growth rate in 2023, this is, San Antonio is sitting at the top of the list for the cities within Texas for GDP growth. So where Apollo Oaks is located, it's located in the northwest submarket of San Antonio, where there are great schools and employment centers, such as the medical education hub, and also, of course, good shopping like the Rim, La Cantera, and entertainment like Six Flags. You're 25 miles from downtown San Antonio, 25 miles to the airport, 10 miles to the medical center submarket, and 10 miles to the major employment, entertainment, and shopping districts. So you got 15 miles to the Amazon fulfillment center. So Amazon has got a huge presence here because it is, the crossroads of I-35 and I-10, I-37. You also have 30 miles to the Toyota Motor manufacturing plant, which is investing 530 million into expanding into its facility, creating over 400 more jobs. And then 40 miles away, you've got a very large 400,000 square foot Home Depot distribution center, which is one of 4 locations in North America of this size. Now, as far as major employers in Northwest San Antonio, you've got the South Texas Medical Center, USAA headquarters, Valerio headquarters, the University of Texas in San Antonio, and there are 1.1 million residents in San Antonio of prime working age, with 1.2 million people that are employed. These are the major employers in Northwest San Antonio, just their campuses. And where Apollo Oaks is located, you can see the site plan here and where it's located within Helotes. Just down the corner or down the street and around the corner is O'Connor High School. And then you also have University of Texas at San Antonio, the Rim and La Cantera shopping, USA corporate offices over here, United Methodist Hospital within 10 minutes or 10 miles away. And the school, the O'Connor High School, it's got an A rating, which is a public school and one of the top schools in San Antonio. So definitely a driver and motivator why people want to live into this area. So why build to rent? Build to rent, because of rising mortgage rates that are happening, affordability is definitely a concern. It's also providing a lifestyle for renters that no longer want to live in an apartment and they're looking for more of a privacy living like a single family house. It's got predictable cash flow and it's one of the fastest growing residential segments, like apartments and single family. So San Antonio's BTR market is booming. And here's a couple quotes from NAIOP and Northmark and Fannie Mae, where Fannie Mae said San Antonio led the nation in BTR rent growth at 6.5% year over year, highlighting its the market's strong demand for single family rentals. So why build to rent in Northwest San Antonio? Well, they've got an explosive population growth of 11.5% over the last 5 years. You have very affluent renters where the median household income is at $81,000, which is 39% higher than the citywide average. High occupancy rates of 96%. Of course, you've got the very limited housing supply. There are no multifamily developments that are happening in this market. And in the next couple of years. And it's very close to major jobs. So limited housing supply and the housing home prices with the median household price in San Antonio is $340,000 and it's been appreciating at 6.4% year over year. The affordability gap, so on a typical mortgage, you're looking at $2,100 and a $1,500 rent for a three-bedroom apartment. So there's a cost premium to renting of $1,200. Now, the development pipeline, there's 7,200 units that are being developed in San Antonio over the next 3 years, which is only 3.2% of the overall market inventory. So 2,300, 2,500, and 2,100 over the next 3 years, where Apollo Oaks is going to be completed and available in January of 2027. So Apollo Oaks won't face a saturated rental market at lease out. Now, as far as the absorption trends, of course, when you develop these properties, you got to have some demand for it. And you can see that, as these new units are being completed and basically tapering off in 2027, the absorption rate does come down because of the available supply, but then the absorption rate increases because there's more population growth and less product being developed. And so the absorption rate is expected to climb up in 2027 and reduce the overall vacancies that are in the overall market and increase the demand. Now, Apollo Oaks, the site plan. So our partner, they were already going to do this deal, and they were moving forward on engineering and permitting. And so this is the actual site plan from the engineers that they're going to be submitting to the permitting department this month in March. But we engaged them back in January, so that already knocked off basically 3 months off of the overall development permitting timeline. These are just some specifications about the lot that we're developing. So 30 duplex lots, about 1,400 square feet per unit, which is a 3-bed, 3-bath, 2-car garage, and 7 acres of developable land. Hardy siding, concrete slab, wood frame, no project amenities. The reason that we're doing that is because it reduces the overall HOA costs, improving the cash flow for the end buyer that will be buying these units. Open floor plans. You can see here that living room and kitchen on the ground floor with the master bedroom and other bedrooms on the second floor. Now, I don't think I mentioned this, but our partner Invest5S has 4 floor plans that they typically build. So they don't divert from that plan. They always build the same thing over and over and over, and so they're very efficient in what they build and how they build it and the amenities that they use within. So each unit includes all exterior includes hardy plank siding, concrete slab, 30-year composite shingles, weather resistant exterior paint, 2-car garage with an EV charger with garage door openers. They have fully landscaped front and backyards with some of the lots that will come with tree coverage. Apollo Oaks, the reason we named it Apollo Oaks is because there's a lot of oak trees in the area that we're going to be salvaging that will remain there as mature landscaping. Private backyards for each unit, 3-bed, 3-bath. Skip on to the next one. LVP flooring and carpet upstairs. Wood blinds, granite countertops, stainless steel appliances, a tech package for keyless door entry and smart thermostat, cable TV outlets, smoke detectors, ground fault interrupters, and privacy bolts or privacy locks on all bedrooms and bathrooms. And of course, we have noise insulation between the 2 units of the duplex. So as far as risk mitigations, as I was saying earlier, the development costs, I've increased it from $235,000 to $240,000. The development costs are based on actual costs from Invest5S historical and current projects rather than third party. And they were confident that they could develop these lots for $235,000, but I increased it to $240,000. Now, as far as the sale cost, We have comps that show $650,000, but I decreased it from 650 to 625 to add a little bit more conservatism in there. And then as far as the timeline, I'll get that on the next slide. But there are some savings there on the overall project timeline. Now, with tariffs as a big topic right now, we looked at the overall impact on 25% tariffs on imports such as lumber and fuel. And worst case scenario, we could be increasing the overall cost of the project by $10,000 to $20,000, which is an approximate 8% increase in the overall building costs. And I have a sensitivity analysis later on in the presentation that kind of highlights what that does to the investor returns. And we've also set aside 7.5% of the sales price to pay for a rate buy down for our end buyer. If the end buyer chooses not to use that rate buy down, we could also use that additional cash that we have set aside for any type of concessions. Now the project timeline, I'm going to jump ahead to the next slide to kind of show you a Gantt chart. So permitting timeline is going to be over 4 months once we close. And once our permitting has been all approved, then we could start our horizontal construction over the next 4 months, taking us to month 9. And then from there, we could start our vertical construction. And so we broke it down into 2 phases, each phase being 15 lots for a total of 30 lots for the project. And so phase 1 will start here in month 9 and be completed in month 15. And once phase 1 is done, then we could start to sell off these units. So I've created a 2-month timeline for actually selling off these units. So even though the units are going to be pre-sold, I've extended our overall timeline by an extra 2 months to add some more conservatism in my underwriting. So once phase 1 is then complete, then we could start phase 2. And then once phase 2 is complete, then we could start to sell off those units over the next 2 months. So the sources and uses, I have an equity contribution of $3.4 million, which is 26% of the total project costs. Debt financing at $9.3 million, 73% of the total project cost, for a total of $12.7 million. And what is that being used for? So if we break that down, land acquisition and development costs of $3.2 million, 25% of the project costs. The overall soft costs, which includes permitting and engineering, taxes and insurance, $589, which is 4.6% of the total project costs. Hard costs, which include horizontal and vertical construction, of $8.4 million, or 66%, and the carry costs, so the interest and the financing fees of $525,000, or 4.1%, for a total of $12.7 million. Costs and fees. So we're developing these duplexes for $240,000, which is $85 a square foot. Selling them for $625,000, or $223 a square foot. For sales costs, we've allocated 8% of the sales costs, which includes a 2% disposition fee for paying the realtors and any other service fees. And then we've allocated 7.5% for a rate buy down for the end buyer. So we're looking at the rent comps. Single family has been outpacing multifamily for rent demand, and you can see that there is positive rent growth over the last 4 years. Now, as far as the rent comps, we pulled together the best comparables that we could find of single family residential units that were 3-bedroom, 3-bath within a 4-mile radius. And you can see that there hasn't been a lot of development in this area in the last 20 years. And so the average age at 2005 for the age of the home, with the size being around 1,700 square feet, and their renting average of $2,000 a month. And the overall renovation quality being an average of a B, where our units are going to be have better finishes, creating basically an A-class property. And there is a build-to-rent community that is currently under construction within 5 miles of Apollo Oaks. It is a much larger community, but there's a mix of 1 bedroom, 2 bedroom, and 3 bedroom. And if you look at the 3 bedroom units, they're 3 bedroom, 2.5 bath, and around the same size of almost 1,400 square feet. And they're advertising it at $2,400 a month, available later this month. So that keep an eye on this. This is going to be a great comp for us to use. But the difference here is all 3 bedroom units have 2-car garages, but they only have private patios and no yards. That's going to be the advantage of Apollo Oaks, providing that private yard for all the tenants. Now, when I look at the sale comps, the average median home in Holotes is $450,000. But there are no duplexes that we could use as sale comps in Holotes or most of the northwest of San Antonio. However, Apollo Oaks is very close to the current development project that's going on with our partner right now, and they're selling these off at $650,000 for the duplex. So a duplex being 650 compared to a single family being 450. So we feel that there's a very strong demand that we'll be able to sell these for at least 625,000, which is what I used in my underwriting. Now, the row at Dietz Elkhorn is probably the best comparable that we have for these duplexes, and they're currently being completed right now. And so there is that demand. There's as far as looking for these type of investment properties, and these two properties or units that I've highlighted here, those recently sold. Unit 19 and 20 sold for $699,000, and unit 13 and 14 sold for just under $650,000. And these are just the coming straight from the contract of those sales. So we are confident that at least we could sell these for $625,000. So in the sensitivity analysis here, I've got basically permitting timeline sensitivity and a building cost sensitivity. So our basis being 4 months of permitting and our sales cost at $625 for investor IRR of 28%. But if we actually sold these for $650,000, that increases up to 31% IRR. But if our permitting timeline increases up to, say, 600% or 24 months, and we still sell these at 625, well, it decreases from 28% to 16.9% IRR. Now, as far as the building costs, and if you remember the tariffs accounting for about an 8% increase in building costs. So if we look at the 10% increase here on the 625, it reduces it from 28% to 23%. But if we sold these for 650,000 at that 10% increase, well, then we're just a few basis, 200 basis points less in IRR returns. So we have a preferred lender for our end buyer. It is CMG Home Loans, and they will provide these loans on a DSCR loan type with 35% down payment. Interest rates are going to be between 3.75 and 4.25 with that rate buy down. Otherwise, it's going to be about a 6% interest rate without it. And that's, we've allocated 7.5% of total sales revenue of 1.4 million to buy the rate buy down for that end buyer. So why we love this deal, all the units are going to be most likely pre-sold. That's our goal. However, I increased our timeline an additional 2 months for each phase to sell it off. Located in a very strong market of San Antonio. I talked about the risk mitigations, engaging the engineer back in January, which reduces our permitting timeline 3 to 4 months. I've increased the development costs and decreased the sales cost. And we have secured a very attractive debt for our construction financing. And again, we're 50% committed on this deal. And that is it. So please let me know if you have any questions, and look forward to chatting with you.